Well, I want to do another video on bonds or fixed income instruments. You can watch other videos related to the topics we'll discuss here today if you want by following these links right here. Today, I want to think about how effective it is to use modified duration to predict the price change of a bond given a price or given an interest rate change. There are lots of figures in this video. Feel free to pause it as needed. I'm going to try to go through this rather quickly. As a refresher, Macaulay duration can be calculated using this formula here. It tells you the average amount of time you have to wait for a cash flow given the bond's coupon payments and maturity dates. We can make a small change to this to come up with modified duration. Modified duration will tell us an approximate change in the bond price given a change in interest rates. Let's walk through some examples. Going to use this particular bond throughout. Face value of 1,000, coupon of 60, which means there are coupon payments of $30 every 6 months. I'm going to change the interest rates or the discount right here so we can see how it's changing. We're going to see if that modified duration gives us an accurate value in terms of the change. For all these charts, you're going to see the price of the bond here. This one's currently at par. You're going to see the Macaulay duration here, and you're going to see the modified duration here, which again helps us determine the price change. So let's go ahead and do that. Here, we're going to say, let's change it from a 6% discount rate to a 5% discount rate. That modified duration of 4.27 tells us it should change by 4.27% or $42.70. In actuality, it changes by $43.76 or an error of $1.06, which you can see here in this particular chart. Now, we could then go again. What if we want to go change from this 5% now that we have to 4%? We're going to see again, you can read the numbers yourself here, but again, we have an error. This time it's grown to $1.18. As you can see here with looking at the prices here, and then we can go one step further. We can go from that 4% to 3% to this number here. And again, we see an error, but in general, we're saying that as we're in this premium bond, right, we're priced higher than par. As we lower the interest rates and further increase the coupon or further increase the value of that bond, the error term grows when we're using modified duration. Let's now look at a bond with more realistic discount rates. We were using kind of 6, 5, 4, 3 there. These are discount rates based on today's environment. Again, you're going to see here, as I've shown in previous videos, that the discount rate you're going to use is going to be specific to each cash flow. Now, what's going to happen here? Well, first off, let's think about what this would look like if those discount rates were the same. If we do that same price bond, if we use a discount rate here, that gives us the same price bond. I'm just showing you that for information purposes. Again, let's go back to this bond. And what happens here if we change every interest rate there, kind of a parallel shift, increase it by 1%, we should see the bond price decrease. In fact, that's what we're going to see here. You can look at the numbers there. Bond price or interest rates go up by 1, and the bond price does go down, but we kind of underestimate that, or we overestimate that using that modified duration. Of course, when we look and think about a yield curve, we kind of alluded to this earlier, that each maturity has a different discount rate, but there's no reason for those to all change in a parallel shift. So what would happen if those change in a different way? We can look at that same bond here with the more realistic discount rates that are matched to each maturity and say, let's just kind of change those a little bit randomly. I use these particular numbers to, if you go down the time periods there. And what happens here? Well, we can't really use modified duration at all anymore. It doesn't tell us anything because it's only going to be valid for parallel shifts in the yield curve. In this particular case, by using these changes, the bond price would decrease by $50. The whole point here is that modified duration has a couple of problems. First off, it's not particularly accurate, as we saw there, and it's just completely useless when it comes to non-parallel shifts of the yield curve. I will follow this up with a subsequent video where we can talk about a way to make that a little bit better in terms of parallel shifts, but again, won't be perfect. That being said, happy trading out there. I'm Brian Kozlowski. Thank you so much.